Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Mandeep Singh joins us here because we want to get some more details on this Broadcom deal because, again, moving the stock big time, helping propel the NASDAQ to a nice move today. Mandeep Singh is a senior tech analyst for Bloomberg Intelligence. He's been telling us about AI for like a couple of years now. And folks, if you don't really know what AI is and you have access to the Bloomberg terminal, just go type in BI Go. That'll get you to Bloomberg Intelligence homepage. In the search bar, just type in AI and it'll bring up, send you to the definitive report. Really large report on AI. What is it? How to play it? And what's the future of AI? It is the definitive research report on Wall Street on AI. And Mandeep Singh is to blame for that. Mandeep, talk to us about this Broadcom deal here. Lay it out for us. What does it mean for Broadcom and for just kind of an OpenAI as well?
Yeah, I mean, look, OpenAI is going after adding as much compute capacity as they can. And they did first 10 gigawatts with NVIDIA, 6 gigawatts with AMD, and now 10 gigawatts with Broadcom. And the difference here is with Broadcom, they get to use their own chips. NVIDIA and AMD are what we call merchant silicon. I mean, that's basically generalized chips where you can deploy the workload you want, whether it's from OpenAI or Microsoft or any other vendor. In the case of custom silicon, which is what Broadcom does, a company like OpenAI or Google makes up almost 50% plus of Broadcom's AI revenue. So Google has their chip called TPUs. They use it for everything run on Google's platform, whether it's YouTube, whether it's AI, whether it's cloud, everything inside Google's run on their TPU. So OpenAI's strategy here is to use an approach which is similar to Google TPUs because it saves you a lot of money. I mean, imagine an NVIDIA AI chip costs you 30 grand. A custom silicon that Broadcom is making for Google costs you 6 grand. Okay. That's the cost differential we are talking about. Yeah. And it's not because NVIDIA has to spend 30 grand to make that chip. They have a 75% gross margin on the chip that they're selling to the customer. So NVIDIA's cost is also low, but they mark up the price of their silicon. Same thing with AMD. In the case of Google, they're going directly to Broadcom to make that chip at a far lower price, and it's for their own use, which is why they don't have to pay the markup to NVIDIA or AMD. And that's why having your custom silicon strategy is so good, because it really saves you. So 1 gigawatt with NVIDIA silicon would cost you about 40 to 50 billion. 1 gigawatt with a Broadcom OpenAI silicon would cost you 25 to 30 billion. So we're talking about a 30 to 40% cost differential, and it's huge. I mean, in the context of what these guys are trying to do, scaled infrastructure.
In addition to that distinction, there's also no investment or stock component to this OpenAI Broadcom deal, which makes it different from the deals that it struck with NVIDIA and AMD. So I guess my question is, how would OpenAI finance the purchase or the chips in general?
And that's a great question, because right now they have to do a lot of financing. It's one thing that's a common thread in the NVIDIA transaction, where even though NVIDIA is putting $10 billion in OpenAI, they still have to find the remainder of the money. So if you imagine, $40 to $50 billion per gigawatt, 10 gigawatts costs you around 500 billion. NVIDIA is only investing up to 100 billion. So they still have to figure out the remainder of 400 billion. In the case of AMD, I mean, yes, they are getting some stock, but you still have to figure out the financing for that, 300 billion or so. Here, it's the same thing. You need the money. And OpenAI's bet is if we keep ramping up our revenue, that is obviously a big source of the funding. We'll do a lot of private deals because we already have the buy-in from these big player, whether it's NVIDIA or Microsoft and other sovereign providers. And I think it's a lot of scale game right now, because once we keep hitting our milestones, we'll keep raising more money. And that's the hope when it comes to OpenAI.
One name I haven't heard during all this dance between all these tech companies is Apple.
Yeah.
What's going on there?
Glaring absence.
Exactly. I think that's the right way to frame it. And look, at some point, I think they are going to go the Broadcom route. Out of the 3 partnerships that OpenAI has had, a company like Apple will never go for merchant silicon. I mean, look at what they have done in their own devices. It's all custom silicon. And that's where, if I had to pick a strategy for Apple, it will likely be custom silicon using Broadcom or Marvell or one of these ASIC providers. But the hard thing for them is, because they have missed out all the action in the past 3 years, it's so hard to catch up. Even if you throw money and, your CapEx dollars, the time is of the essence. And the longer they delay this, I feel either it's Broadcom or a partnership with Google now that antitrust is behind. So they may very well adopt Google's LLM across their
that would
device.
be huge.
That will be huge. But I think with the regulatory overhang going away, that could be a very likely strategy.
Apple has a ton of cash. It can't buy its way to a solution here.
Who do you buy? I mean, these are all scale players. AMD,
I'll put a deal together.
Broadcom, maybe you could say Marvell is a smaller player, but you need the best end chips. That's why everyone is buying NVIDIA, because they have the highest performance per watt. So you can't really get a second or a third player, because then you compromise on the performance per watt when the biggest constraint out there is power. So, you need the leading player when it comes to the chip side of the equation.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Let's get back to what's happening in the markets. One of the concerns, and Scarlet mentioned a couple times here today, is in the credit markets. Do we have some concerns out there? First Brands, for example, their challenges there have really spooked some parts of the credit market. We want to get the latest on what's going on there. We check in with Steve Mann, Bloomberg Intelligence, Global Autos and Industrials Research Analyst. Steve, from your perspective, just tell us, for the people out there that don't know who First Brands is, who are they and what happened?
Yeah, First Brand is a big, huge aftermarket parts supplier. They, some of the brands are really well known in the markets. Parts include like brake pads, engine oil filters, windshield wipers. So a lot of these are just very fast, wearable parts that everyday consumers buy.
Okay, so it's something that's quantifiable, it's knowable to consumers, and it kind of shocked everyone when it ran into financial problems. And I know that everyone's still trying to uncover how much of this is perhaps corporate malfeasance, or there might be some fraud going on. But it happened at the same time that another company named Tricolor was also falling apart. And both of these are tied to the auto sector. They're not making cars and selling cars directly, but they are tied to the business of selling cars, or the business of taking care of car consumers afterwards. What does that say about the car industry, Steve?
Yeah, I think those two incidents really freaked out the market. But based on our research, I think those are really contained situation to those companies, and don't feel there's a broader impact. But you never know. The market's based on investor sentiment. But we did some research on the impact on the aftermarket parts market. Companies like O'Reilly, AutoZone, and Advanced Auto Parts are unlikely to see impact on their supply chain. Like I said earlier, these are high commodity parts. There's a lot of producer that actually produce wipers and brake pads, not just First Brands. So it's not going to impact the consumer. It's not going to impact companies like O'Reilly or AutoZone. It actually may be beneficial to the aftermarket retailers in terms of higher prices.
How important are these aftermarket retailers? I mean, it seems, I keep hearing, I'm reading your research, that people are holding on to their cars longer and longer and longer, and therefore this afterparts is a pretty good business.
It is a very good business. It's a relatively high margin business, great for cash flow. So in this instance, with First Brand, companies like O'Reilly, AutoZone, doesn't really, on a financial perspective, doesn't really deal with First Brands. They buy parts from First Brands. But they pay the financial institutions, and this financial institution actually pays First Brand through these what we call supplier agreements, finance agreements. So these auto parts retailers are actually shielded from what's happening with First Brands.
The news, of course, today is that First Brands' founder and CEO, Patrick James, someone that a lot of people don't know and haven't heard of, he is resigning because, of course, the company is facing an investigation over its finances, and he will be replaced by Charles Moore as an interim CEO. This is very inside baseball, Steve, but what I wanted to get to is this idea that a lot of people are not overly concerned that this spells broader problems. At what point might you get a little bit more concerned?
I think if there's a contagion effect, which I think is a low probability. The other issue is the supply chain. Is it gonna, if First Brand does stop operations and stop producing parts, does it impact the supply chain of like O'Reilly and AutoZone? I think temporarily it does, but what really could happen is that O'Reilly and AutoZone will probably raise prices and actually will help juice up their margins.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
M&A, media, likely to be some type of media activity, M&A activity in the media space, as some of these companies need to consolidate even more to get even more scale to compete against the Netflix of the world, not to mention the Amazons and the Apples and so on and so forth. So one of the deals that's out there potentially is Skydance, Paramount, maybe doing a deal with Warner Brothers Discovery. Let's see where we are right now. There's been a lot of rumors and a lot of news reporting about a potential hookup between these two companies. Geetha Ranganathan, she looks at this stuff. She's the U.S. media analyst for Bloomberg Intelligence, located in our Princeton, New Jersey office. Geetha, I mean, the scuttlebutt is, Paramount is interested in buying Warner Brothers Discovery, but we haven't seen Warner Brothers really open to a deal, at least not at the prices that have been bandied about. What's the latest?
Yeah, the latest, Paul, is, as you just said, that there have been rumors now ongoing about these possible sale talks for over a month. Over the weekend, Lucas Shaw and Bloomberg News basically broke the story that Warner Brothers did receive an offer for at $20 a share. But David Zaslav, the CEO of Warner, has basically rejected that offer as being too low. Now, we know from some prior reporting that he had been looking for something like about $40 a share. So obviously that's a huge gap right there.
And I'm just looking at the size of these companies. I mean, Warner Brothers Discovery has an enterprise value of more than twice that of Paramount. How's that math going to work?
Yeah, so this is what we've been kind of, scratching our heads about. So initially, when we had, the news come in, one of the big pieces that was mentioned was that this was going to be a majority cash deal, and a lot of the funding was going to come from the Ellison family. Now, things seem to have changed a little bit last week because we heard that private equity players were getting involved. So Apollo was one of the names that was mentioned. It looks like Paramount had approached Blackstone, but maybe they were not really that interested. Legendary was also thrown into the mix. So we're not completely sure just yet whether, Paramount is going to proceed with a higher offer with some of these external sources of financing, or whether really the Ellison family is kind of going to, step in and, basically fund majority of the acquisition.
Well, it's not like you can't afford it. I just typed in Rich Go, RICH. That's the list of the top most wealthy people in the world, according to Bloomberg. Mr. Ellison is number 2 with a net worth of $350 billion. So there's certainly some capital there to be deployed. Geetha, what's the sense of timing here? I know Warner Brothers Discovery, they're actually pursuing a kind of a parallel path, which is they're separating their businesses a little bit? Tell us about that.
Yeah, so I really think here the odds are in Warner Brothers Discovery's favor. And I say that because, as you just pointed out, they are on this path to separating the two companies. They're separating out the TV networks, which really doesn't have a great growth outlook, from their streaming and studio assets, which, by the way, is just doing extremely well. The studio has had an absolutely fantastic run this year. They're making up almost 30% of the box office. They've had hit after hit after hit. Wow. So they really are on a winning streak. And this is what I think gives David Zaslav a lot of confidence that he can get top dollar for at least the streaming and studio part of the business. The real problem, Paul, and you know this very well, is what the outlook is going to be for the TV networks. And that's where I think it's a little bit of a double-edged sword, because the Paramount offer right now is for the entire company, which means he gets to offload, the TV networks, doesn't really have to worry or think about it. The thing is, if he waits and, pursues the split, of course, streaming and studios is going to do really well. But then again, we're stuck with the TV networks business without, much of really a future, a proper future, good outlook for it. So that's really where the dilemma is for the Warner Brothers Discovery management team.
And what's interesting here, I think, particularly if you're a banker or a lawyer trying to put a deal together, is we have a willing seller here. Mr. Zaslav has stated he's willing to sell, and stated that it probably makes sense for this industry to consolidate even more. So it sounds like it's just going to come down to price.
It is going to come down absolutely to price. I mean, he's already kind of said on multiple occasions that, there are people who are interested, especially in the streaming and studio part of the business. He is going to push very hard for on the price front. We know he's a really tough negotiator, but I'm not really sure how much Paramount is going to be willing to pay up for this.
So broadly speaking, for these networks, did they go to zero with cord cutting?
They won't go to zero, Paul, but they're definitely, the floor has been going lower and lower. So you very well know that, at its peak, pay TV households were somewhere at about 104 million in the country. Today, they're at about 65 million. The idea, or at least the thinking on the street, is that this is probably going to go to somewhere like about 40 million, maybe in the next 3 to 4 years. But who knows? The rate of decline has been pretty dramatic. Even when Warner Brothers and Discovery came together a few years ago, remember, they had projected $14 billion in EBITDA. That number, we never got anywhere close to that number. Wow. This year, we're looking at something like about $8.5 billion or $9 billion in EBITDA. So it's just such a big gap. And that's just because of the dramatic decline in the TV network business.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.